Hi, folks. This is Mike Zlotnik, Big Mike. And today's discussion is going to be all about the Fed latest move or no move. They kept the rates flat, with Fed target rate being 5.25% to 5.5%. Before we do that, usual disclaimer. This is for informational and educational purposes only. No advice of any kind, no solicitation of any kind. If you're interested in our funds and syndications, request PPM. To create investors only, consult with the attorney, CPA professional. So the Fed has decided not to push interest rate any higher at the last meeting, which is actually great news. It was widely expected because the yields in the 10-year Treasury notes have gone up to almost 5%, and they thought it was sufficient to slow down the economy to the point where the action in the Fed funds rate would not be necessary. And guess what? The markets are responding. The markets are speculating at this time that the Fed is done pushing rates up. They've held the rates flat in September. They are holding the rates flat now in November 2023. And they still have opportunity to raise, of course, in December meeting and into 2024. But the likelihood of them pushing rates up has dropped quite a bit. Now, of course, they're very data dependent, and they reserve the right to act. They see inflation being very sticky, and it's a possibility. In this world, you can't accept everything on a 100% basis, but mathematically, it's probably 75% chance they're done, maybe even higher. The good news is that 10-year Treasury has actually reversed the direction. It's kind of funny how it works. When the song was hawkish, 10-year Treasury essentially kept climbing, and now the song is a little bit more flatlined, and I think investors are beginning to realize that the interest rates at the current level are already doing what they were supposed to do. So Fed action is known to have long and variable legs, and the time it has taken for these interest rate hikes to propagate through the economy has been sufficient, that now we should start seeing some slowdown. Now, the unemployment is still at the very historically low levels, and that's one of the biggest concerns that's making it difficult for the inflation to come down. Nonetheless, based on kind of the history of the past and based on the fact where the data is coming in, where the consumer sentiment is at, it would appear that Fed has done enough. Now, how long will they keep the rates at this level, right? It's all these are crystal ball questions, and your guess is as good as mine. But historically, Fed has kept interest rates at the peak for usually 6 to 9 months, some cases 12 months. So the last hike was in July 2023. So if you add 6 months on top of July, you're looking at Q1 2024. So January, February, that timeline is probably the earliest that it is theoretically possible for Fed to start easing. Again, they're still reserving the rights to hike, and we are already asking the question when they're going to start easing, right? But for most folks in real estate, and we are real estate investors, we would like to see Fed starting to ease, because that would substantially, well, it would improve gradually, depending on how fast they hike, how fast they ease. It would improve many real estate projects, because returns on equity very much depend on interest rates and cost of debt and debt leverage available. So it would appear that they stopped. Earliest time they could start easing is probably Q1 of 2024. Probably, again, mathematically, the Q2 is a more likely scenario. So at some point in Q2, we should start seeing some level of easing. Of course, depends on data, but at least this gives you a basic perspective on our view of the world. And at least the expectation of no more hikes is a very positive news for the economy, because 10-year Treasury can adjust in response to that, because investors make decisions based on forward outlook. And the forward outlook right now is that we're going to be in a flat environment, and the easing will start at some point in the first half of 2024. So I appreciate your time and attention. This was a short video, just a commentary on the latest action from Fed. Please reach out with any follow-up questions. Appreciate your time and attention. Have a great evening.